account debit to outstanding salaries account. Okay, so it is 1000. It's 1000. Okay, salaries is, since salaries is an expense is a part of nominal account. As per the nominal account, we are debiting the salaries. Since we have to debit the expenses and losses, so we are debiting the salaries. Outstanding salaries is a personal account. In the personal account, the rule is the debit the receiver and credit the giver. Since outstanding salaries is a part of an obligation he has to give, we are crediting the outstanding salaries, being salaries are outstanding. Salaries are outstanding. This 1000. I hope you are clearly understood. Now, next, interest on 24th of the January, we have another transaction, interest paid on borrowings. Interest paid on borrowings. Okay, so interest we have already paid. Interest paid on borrowings. What does it mean? We have two items here. Interest paid. One is interest and another one is we paid in the form of cash. So another one is cash. Interest paid on borrowings. So we have to identify two items. One item is interest and another item is cash. So interest is an expense. Expense is a part of nominal account. What is the golden rule of nominal account? Debit all the expenses and losses, credit all incomes and gains. Okay. So since interest is expense, we have to debit the interest. And then cash. What about the cash then? Cash is a real account. Is it coming in or going out? Whenever we pay interest, cash will go out. So we have to credit what goes out. We have to credit cash. So journal entries on January 24. It's like interest account debit to cash account. How much amount? 400. What is the narration? Being interest on borrowings paid. Whatever the borrowings they have taken from other parties, they have to pay some part of an interest over those borrowings. Since interest is an expense of the transaction, we have to debit as per the nominal account rule. Since expense is a part of the nominal account, the golden rule of nominal account is debit all the expenses and losses, credit all incomes and gains. So we are debiting the interest account. And cash is, since cash is the real account, cash is going out as per the real account. Debit what comes in, credit what goes out. So we are creating the cash account. I hope you are very clear with this transaction. Next transaction is on January 25th. We have transaction paid cash to Mr. Bean. Paid cash to Mr. Bean. So whenever we pay cash, cash will go out, and here Mr. Bean is the receiver of the cash. We have paid the cash to the Mr. Bean. Here Mr. Bean is the receiver. So we have identified two items here. One is the cash and another one is the Mr. Bean. So cash is the real account. As per the real account, debit what comes in, credit what goes out. Here cash is going out, we are creating the cash account. Since Mr. Bean is a personal account, as per the personal account, debit the receiver, credit the giver. Since Mr. Bean is the receiver of the cash, we are debiting the Mr. Bean. So journal entry is on January 25. January 25, the journal entry is Mr. Bean account. Mr. Bean account debit to cash. Since cash paid to Mr. Bean. Amount is nothing but amount 1000 rupees. 1000. Being cash paid to Mr. Bean. Cash paid to Mr. Bean. Amount is 1000 rupees. Since we have paid cash amount of rupees 1000, Mr. Bean. Mr. Bean is the reserve. We are debiting Mr. Bean. Since cash goes out, we are crediting the cash account. Okay. Next. Next transaction is goods withdrawn for personal use. Goods withdrawn for personal use. What have to do? Look over there. Goods. Goods are nothing but, see, goods withdrawn from personal use. Goods withdrawn for personal use, rupees 500. Rupees 500. So drawings, as we earlier said that it is a part of the drawings, right? Goods withdrawn for personal use, drawings. So drawings account is okay. So generally goods are going out. So goods are nothing but it is a real account. Real account. Understanding over there? It is a real account. Goods account is a real account. Since goods are going out, we have to create rules. As per the rule of the real account, we have to do the credit. Debit what comes in, credit what goes out. So since goods are going out, we have to credit. What? Then what? In the what form? We are not supposed, as earlier said, that we are not supposed to put the goods, the term goods in any kind of organization, in any kind of transaction. So we have to put it is in the form of purchases, in the form of purchases account. So goods withdrawn for personal use, rupees 500. So what we have to do, it is in drawings. On January 27, it is drawings. Since drawings is a personal account, debit the receiver. So he is a receiver. So drawings account debit, drawings account debit to its purchase account in the form of purchases account. Rupees 500. Rupees 500 being goods withdrawn for personal use. Okay. Then the next transaction. On same day, on 27th January, again we have another transaction. Received check from Mr. Raju. We received check from Mr. Raju. So what we have to do generally? Check. Generally, we received check from Mr. Raju. So obviously it is our organization. Definitely the bank balance of the organization is going to increase. Since the bank balance is going to increase, we are receiving the check check in the form of bank balance. So bank balance is increasing. So personal bank balance is a personal account. So we are receiving, since debit the receiver, so we are debiting the bank account. January 27 bank account debit to, since Mr. Raju is a personal account. What is the role of a personal account? Debit the receiver, create the giver. Since Mr. Raju is the giver, we are creating the Mr. Raju to Mr. Raju account. It is 2000. It is 2000. Okay. Next transaction. Being, what is the narration? Being received check from Mr. Raju. Since we have received the check from Mr. Raju, we have passed journal entry bank account debit to Mr. Raju account. January, next transaction is on January 28, issued check to Mr. Lal. We have issued the check to Mr. Lal here. So we have identified two items. One is the bank and another one is Mr. Lal. So since both are the personal accounts, we have to debit the receiver and credit the giver. So we are issuing check to Mr. Lal. Here Mr. Lal is the receiver and our bank is the giver. So debit the receiver and credit the giver. So what is the journal entry? Mr. Lal account. Since he is the receiver, debiting the receiver, Mr. Lal account debit to bank account. Okay, Mr. Lal account debit to bank account. Amount rupees 2000. Being check issued to Mr. Lal. Check issued to Mr. Lal. I hope you understood, right? Since Mr. Lal is a personal account and bank even is a personal account. So we issued a check to Mr. Lal. Here Mr. Lal is a receiver. So as per the rule of the personal account, we have to debit the receiver and credit the giver. So since Mr. Lal is a receiver, we are debiting the Mr. Lal, and our bank account is a giver. We are creating the bank account. I hope you all clearly understood. And next transaction on January 29. January 29. Interest allowed by the bank. Interest allowed by the bank. What does it mean? Interest is allowing interest. We are getting interest from bank. We are getting interest. Since we are getting an interest, bank has allowed the interest for us. Since bank is allowed interest for us, so that interest is income. So income is part of the nominal account. So as per the nominal account, we have to debit all expenses in losses and credit all incomes and gains. So since interest allowed is income, so we have to credit the interest amount. So our interest amount, and since our bank balance is going to increase, bank balance, we are getting amount in the bank balance. So bank is a personal account. We are receiving the amount. Since as per the personal account, we have to debit the bank account. Bank account debit to bank account debit to interest account. Bank account debit to interest account. 200. Interest, since what is the narration? Being interest allowed by bank. Okay. So the next transaction. Withdrew from bank for office use. Withdrew from bank for office use. We have withdrawn the bank. We have withdrawn our bank balance for office use. So what happens? We will be getting the cash. Another one is our bank balance is going to get reduced. Bank balance is going to reduce. Our bank is a giver and we are the receiver. We are getting the cash. So on January 30, on January 31st, we are getting the cash. So what comes in? Cash comes in. Cash account debit to giver. Debit is the receiver and credit the giver. So our bank is a giver, so we are creating the bank account. Cash account debit to bank account. Okay. Cash account debit to bank account. So how much? It is 300. It is 300. Being withdrawn for cash. Withdrew from bank for office use. Right. The final transaction on January 31st, we received commission. So we received commission. We have two items here. One is received commission received. Another one is cash. We received in the cash. So on January 31st, we have another transaction. So cash is coming in. We have to debit. Cash account debit to commission received account. How much? It is 100. I hope you clearly understood the thing. Cash account is the real account. As per the real account, we have to debit what comes in. Since cash is coming in, we are debiting. And commission received, it is an income. As per the nominal account, we have to credit the income. So we are crediting. So narration is being commission received. I hope you have clearly understood all the transactions. So with this, I am concluding this problem. If you really liked this video, if you really liked this explanation, you can subscribe and press on the bell button. Hope in further, I am going to explain the various topics. in the accounts, financial management, business laws, and even current affairs. Okay, thank you. Jai Hind.